I will say I'm very skeptical of everything.
Data has shown that homeowners are very solid on their financial base.
I don't think any of that data is going to matter. I don't think any of that modeling is going to matter the way it once did. Americans' balance sheets are extremely healthy. That's like one of the last things I want to look at as a business owner is a balance sheet, because there's one thing that matters for every business owner, and that's cash. Cash equals oxygen.
I have one question on the New World Order thing.
It's the new agreements of shipping routes. What has controlled every global economy in history has been shipping routes.
When you say they don't have cash, what data are you looking at?
95% of America is not experiencing what the ultra wealthy are experiencing.
So this is the baseline for the big 2026 crash then?
I think you're confusing in what a crash is and isn't.
Welcome to a special episode of the Made to Be Great podcast. I am joined by two industry heavyweights. We've got Logan Mohtashami and Colton Lindsay. So welcome, guys, to the show.
It is good to be here. A lot of fun.
Yes. Excited to have you both. So today we're going to talk about what originally sparked this, which was a prediction that the housing values may decline up to 50% in 2026. There was some conversation, some friendly conversation on social media, which prompted this this episode today. So I'm grateful to both of you guys for being here and being willing to take time out of your day and give the people what they want here. So I appreciate that.
For sure.
Before we get into that, I'd love to share a quick mini bio on each of you. Colton, if you don't mind rolling first. I was going through your Instagram yesterday and saw a really cool reel where you shared kind of some of your story high level from beginning to now. So if you don't mind giving that.
Yeah, I'll just in a nutshell, I've been in real estate since 2005. Got into real estate because it was the one way I could see the opportunity to make money. I saw that as a pathway. I was very naive during the Great Recession, but I'm very thankful to live that experience because I got to watch these big developers and big producers in my area just go bankrupt. And for me, I wasn't extremely successful yet at the time. So I got to experience short sales, crashes, foreclosures at a time where I didn't know any different. So I thought that was really cool. It wasn't pressure. It was the opportunity to make money. I always had fascination ever since then on, okay, how do I create security financially going forward? So I became really interested in gold and silver at that time, studied a lot of that. By 2012, I was selling 75 to 100 homes a year. 2014, I started making money online, really helping other realtors grow their businesses. That was by mistake, not by design, I will say that. Built a brokerage, sold that, built a team, finished that off, sold my book of business as a real estate agent in 2018. I think for me, what I realized is I became obsessed over that decade of a couple things. Quantitative easing, I became obsessed over that. I had a lot of Gen X in me where I was very skeptical of the system, especially of the government and anything they were telling us in regards to how economy was working. Became a big fan of Jekyll Island and understanding fractional banking. And then I became a student of human patterns. I do a lot with Tony Robbins over the last decade, platinum partnership for the last 5 or 6 years. And so I've studied patterns. And so around 2020, 2019, I started seeing some major patterns shift in real estate agents, particularly, which I think that trend is coming to fruition. I don't know if you guys are seeing this. We're down to 1.3 million realtors now officially to NAR. I think we'll be down to about 750 by the end next 2 years or so. But then watching COVID and watching how things played out and watching the amount of money printing happening, I got really obsessed to understand historical cycles. And so understanding long-term and short-term debt cycles has been fascinating for me. I work with my own company. I train realtors how to exit production at this stage after I sold my business. And then I have a partnership with Real Broker. I don't know if you guys are aware of that. So I've got about 4,200 agents in my network at Real Brokers as well. And so I look at the market more as what creates sustainability from the space of a realtor, and how are they going to continue to grow going forward? Because I think the reality is most aren't, and
Mm,
that's what I mainly focus on at this point.
very cool. Thanks for sharing that. And your content drew me in, and that's how I originally started
Oh, good.
following you. So um, appreciate that
Well,
background.
I think that's the point of content, is it's not to get everyone to agree. It's to
Yeah.
get dialogue going, and some people will agree, some people won't, some you'll find middle ground. I don't think it's a matter of being, my perception is, and we'll go into this conversation, is I don't think anyone really knows what the on in the future. I think we just can look at patterns and make our best guesses on which way directions are going. And sometimes we're going to be right, sometimes we're going to be wrong, right? I don't
Yeah.
think there's any guarantee.
Yeah. And that's a great segue to Logan, because something that drew me to you, Logan, was instead of predicting an exact decimal number, you use channels and charts and models, which I appreciate, because it's like, no one has a crystal ball, right? But you can look at the clues. And so, so Logan, tell us about yourself. You're a ball coach. You were in mortgage.
Yes.
Now you're an analyst. So tell us your
So,
story.
so my story is, in the previous century, I was planning on just being a history teacher and coaching high school basketball, but I think the starting
Huh.
salary back then was like $26,000. So our family's been in banking since the late 1950s. I was a loan officer for 17 years. In 2010, Jason Resnick from Benzinga wanted me to write about, economics. I told him I'd, really would just write about real estate. Created my own blog, did my only things in the last decade. One of the things I've talked about is that housing was going to have its weakest recovery cycle ever in history, demographics, the backdrop for growth was not going to be as strong. But come years 2020 to 2024, the household formation demographics with the millennials would get a little bit more kick back then. At the end of 2019, Housing Wire, with 2 weeks left, hired me to be their lead analyst. I've given my work to the Federal Reserve, the Conference Board, the White House. And my job is to run economic models through economic cycles, then through housing data first. So a lot of people know me for all the charts that we've created. When COVID happened, a lot of people know me for the COVID-19 recovery model on April 7th, talking about, the U.S. is going to recover this year and housing will be back within 6 to 8 weeks. And then after that, just basically formatting how our weekly tracker has worked. Mike Simonson, who's now the economist for Compass, we incorporated both of our models together. And the weekend tracker is designed to look forward in housing with live, fresh weekly data. And we back test this stuff and go back to historical models and try to scope out what's happening today. So our things look out 3 to 6 months ahead. We're always 2 to 3 months ahead of the NAR. We're always 3 to 6 months ahead of the Case-Shiller Index. And then our job is just to show this every single week. So a lot of people know me either going on TV or speaking on the tour or constantly talking about data on Instagram and other channels. So I'm just basically a data nerd in an area where social media has now become the avenue of transmitting information, where 2,000 years ago, I would have been some old guy in a dungeon reading scrolls. Now we have Instagram and TikTok and everything. So my job is to try to make economics as fun as possible, but also understandable out there. And anybody who's seen my live presentations, we do aggregate data and just go with that. That's kind of what we try to preach at Housing Wire.
Yeah, I appreciate that. You guys both do a great job at that, actually, of presenting data in a fun way on today's platforms. And before we get into it, I want to thank you both again, because we started this conversation knowing we disagree. And, just talking through that is going to be super fun. So I appreciate you guys both being here. Um, so in our next piece, Colton, do you want to start off by kind of g- giving a high level of where you were going with your original claim of, hey, based on the patterns I'm seeing, to your point about pattern recognition and looking at macro data and patterns, what are you
Yeah.
seeing that's like, hey, I might see a 50% drop in value?
I think what we're seeing, well, I'll sum it up with one little phrase: cash flow crisis. Um, I've arrived at a space in my life where I don't have a cash flow problem, but I see a lot of people that do have cash flow problems. We're seeing such radical shifts. I mean, you're seeing them change geopolitically, and I think the end of the American world order is here, right? Like what we've been used to since at least in my lifetime, and really since World War II, it's ending. We saw what America did great since 1944 is it built a really strong middle class. It controlled shipping routes. And then something shifted around 1971 when we left the gold standard. And we started really pushing the dollar reserve, and it's gone bonkers ever since then. I think we really saw that spun off after President Clinton. You know, he had, I think, the last president, maybe Logan knows better than me, to have a surplus in the cash. And then you saw what Bush did, and then Obama did, especially after that crisis. And I think a big indicator, looking back for me, that we were going to eventually get to some major problems again was how they fixed the last problem, which is by printing money. I will say I'm very skeptical of everything. So I come more from the Robert Kiyosaki side of things, which is like the crash is always coming. But I think we look at the bull run we went from really 2012 to kind of where we're at today is it's been a bull run based on cash being printed into reality. And so there's so much debt now at $38 trillion. The affordability of a human's life, right? Weighs into, in my opinion, several factors. We got $1.25 trillion in credit card debt today. Half of Americans estimated, from what I can see, are upside down in their auto loans. A quarter of these people are trading these vehicles in, they're upside down. You look at just the cost of housing today. People have had money, maybe not even money, but asset in one place. And you guys know this, it's been their equity in their home. And it's locked up right now. And the reason why people haven't wanted to unlock it is because with those 3 and 4% interest rates, it doesn't make sense. So my whole point of view is I look at human patterns, and I think there's a lot we just don't know that's going to happen. Like I knew things were going to happen in South America. I didn't know that we were going to freaking fly in with helicopters. Maybe you guys could see that happening the way it did. I didn't see it.
Not me.
Um, right. At least with that amount of military force. Does it surprise me? No. Did I guess it? No. So when I look at these patterns, the patterns that I can see most predictable from my point of view is the average American here in the US, they're running out of cash options. They're running out of more credit cards to put stuff in. They're running out of these things. And so with the downward pressure of mortgage rates, if they do get low enough, I believe it'll get to the point where a human being will say, you know what? It's time to unlock my equity, not through a HELOC, not through a second mortgage. Let's sell the property. I don't really love this house anyways. I could pay off the auto loan. I could pay off the bad debt. I could pay all of this. Maybe I'm going to get a 5.25, a 5.5% rate, but I'll at least be able to get rid of all of my debt. And I think there's one indicator that as we go through this, Logan and I actually do agree upon. And I think it's where he's coming from too, is it's listing inventory. And I don't think we're seeing that indicator quite yet, but I think that that's what will trigger this. And I think my point of view is I'm looking before the inventory goes up, what will cause it to go up. I personally think versus the last, really the Great Recession was subprime market. We all know that. I think this will be a cash flow crisis that people are just tired of feeling where they can't breathe financially, and they'll want to unlock that equity. That's my perception that will bring more inventory to the market. And when you get in that spot, just like most investors, a lot of Americans are really stuck to the idea of what their equity is, even though it's not real. But like most investors, when they're done with the deal, they're done with the deal. Do they want to lose money? No, but they know that they need to move and rebalance their capital. So I think you'll see these Americans say, hey, you know what? I'm willing to come down on my price so I can unlock this equity that can finally get out of the storm that I found myself in. That is, in a nutshell, the way I see things going. I will say I don't know exactly how things are going to roll because of the black swan situation. Like, I didn't see pandemic coming. I didn't see Venezuela happening the way it does. And I think there's going to be a lot of stuff over the next 4 years that I don't see coming that is not going to be a surprise, but is absolutely going to happen in the climax of the end of the American world order. So that's the summary for me.
Awesome. Appreciate that. Logan, you were.
So my job here is just to basically talk about like how housing economic models and cycles have worked. Post 1940, it's really rare for nominal home prices to fall. I mean, if I take 2007 and 11 out of the equation, the only times home prices fall, 1990, they fell 0.7%. 1991, they fell 0.2%. Housing acts differently because it's very sticky, right? And housing supply is basically still a function of demand because 70 to 80% of home sellers are buyers. So we've had many economic cycles post World War II. We've had many recessions. We've had many short-term shocks into the system, either a world market event or a short-term event. But one thing that has always been constant, housing doesn't move like other financial assets because it's the cost of shelter. And where I disagree with is when we look at all the credit data, either the World Bank, the Federal Reserve, New York Fed, Goldman Sachs, anybody, household balance sheets in America have never looked better that are homeowners. Renters are a different situation because rent inflation on the lower income side, but FICO score data after qualified mortgage, majority of that is 740 and above. Household debt payments versus the total liability costs for disposable incomes are near all-time lows. Homeowners and got fixed because of two laws that happened. The 2005 bankruptcy reform laws that changed the amount of credit that could be expanded to a household, and the 2010 qualified mortgage law. So for 15 years, the data has shown that homeowners are very solid on their financial base. Forget about the nested equity position. It's the fixed debt cost and rising wages. Other countries around the world have much higher home prices versus disposable income than us just because they borrowed off short-term debt for 20 to 30 years. So household balance sheets look good, but let's just do a hypothetical. Let's say there are many stressed home sellers that come onto the market. Our model is basically designed to capture things weekly. Like we're always going to be ahead of everyone else. And just to give you an example, in 2007, Mike Simonson, when he created Altos Research and we've incorporated our models together, he's the one that actually went to Lehman Brothers and said, hey, listen, we have a way of tracking housing and it looks like it's breaking to us. Lehman Brothers laughed at him. He went down 10 feet, saw Goldman Sachs. Goldman Sachs saw the data that we have and ended up shorting the housing market, and Lehman Brothers went out of business. So our key is that if there's ever any kind of housing stress beyond the normal curve, our new listings data will pick it up. Our new listings data are homes that come onto the market that do not have an offer right away. Normal during the seasonal peak months are 80 to 100,000 on a weekly basis. During the housing bubble crash years, that was running at 250 to 400,000 per week for years. Those were stressed sellers going into an underwater marketplace where active inventory went from 2.5 million in 2005, went up to 4 million. Home sales peaked in 2005, they crashed. The inventory data looks completely different now because the credit data looks completely different. So even in the last 3 years where mortgage rates were ranging between 6 to 8%, the new listings data still has not even got back to normal, right? And I'm hoping it just gets back to normal this year because you need more sellers that will be buyers and the housing ecosystem works that way. So what I'm talking about today is we actually have a model that's worked for a very long time. And still today, existing home sales have risen since mid-June. We're at multi-year highs in demand. The growth rate of inventory was running at 33% last year. That has declined all the way to 10%. New listings data still does not show any stress. So I don't see anything in the current data that's looking out already a few months for 2026 to be the case. And we always like to framework the stress data in 2005, where the foreclosures and bankruptcy data were rising in 2005, 6, 7, 8. Then the job loss recession happened. That data line is still not even back to pre-COVID levels. And because housing moves very slowly, right? It takes 9 to 18 months to start a foreclosure process from a 30-day late, 60-day late, 90-day, 120 NOD filings, judicial stays versus non-judicial states. 2026 mathematically can't be the year because it's already too late, right? You would need to see new listings data go 3 or 4 times above the normal curve in the last decade. And then you need not stress sellers, you need equity sellers to all coherently work together across the nation and have that stick. And that's the way you could create some kind of price. But even back then, we don't have that data because 2008 was out of the 30% or 29% nominal declines that we had during that period. Even 2008 was only a 12% decline. And that was the bulk of the credit stress data, the inventory data, the foreclosure data. None of that stuff is here. out there. So it's very hard to model out a unilateral, all sellers acting in a stressed fashion. And even if it was the case, we would see it in the new listings data. It's just not here. And the year's already started off at multi-year highs in purchase application, multi-year highs in pending sales. Inventory growth has slowed down. We're not quite back to normal, but we're at a good enough level to not have prices escalate out of control or anything. So I think this is the wrong year to format that. When you go into a crash scenario, you really have 18 to 24 months of data actually getting deteriorated on the inventory sides because housing moves so slowly, right? Stocks could flow in down, margin calls, all this stuff. You don't get margin calls to liquefy a house at 12 o'clock p.m. like you do in equity. So housing's just way too sticky to have that big of a velocity move. And when we go back all the way, even if you could take the data to 1910, it's just not this kind of marketplace. The backdrop isn't here. And we're already starting out the first 3 weeks of the year as a positive demand curve with the inventory growth already slowing from the peak of last year.
Colton, do you have any
Yeah,
comments or thoughts
I
on
think
that?
that's why it's so important what I talked about at the beginning of the end of the American world order. I don't think any of that data is going to matter. I don't think any of that modeling is going to matter the way it once did. When you look at a long-term debt cycle, it's based on the amount of currency that's happening with fiat currency. And when you look at, we have $38 trillion in debt. I get measure on the listing inventory. Yes, I get that there's a delay in that. I don't think you're measuring what flies and makes an economy run. It's transactions. We've been 4.1 million transactions each year for the last 2 years. We're not having it. Historically, it's 1/5 of the US economy. It's not happening to be 1/5 of the US economy right now. And the only way that we get the economy cranking again is getting transactions happening. It doesn't mean that transactions have to have the prices going up. Transaction count can increase with having volume of home prices go down. That's very possible, and I think is much, much likely to go forward. But what is happening when we start to see the end of this long term debt cycle? We're going to start to see the fact that people will have the pressure internally in just their expense line. Let's look at, you said a couple of things like the balance sheet. Americans' balance sheets are extremely healthy. That's like one of the last things I want to look at as a business owner is a balance sheet, because there's one thing that matters for every business owner, and that's cash. Cash equals oxygen. You have to have either cash or credit to be able to make a transaction happen. When we saw the last recession, it is because we had an abundance of credit available, we had an abundance of cash available, and then all of a sudden that turned off because everything started to collapse and people stopped lending. We have a lending issue right now where people cannot get credit, not the way they were able to get the last decade that pushed all these prices up. And I look at Mark Howard, the one of the founders of Oak Tree Capital. He calls this the decade of high interest rates. Now, if interest rates stay where they're at, I don't think we'll have the crash. If interest rates come the way that the Trump administration wants them to go, and that most people want to go, if we start to see 5.5%, 5% rate, especially, I can't imagine we can sustain below that. I can't even imagine we really sustain much below 5.5%. That's my personal opinion. But if we see that downward pressure on rates, that gives a person that is tight on the oxygen of cash a reason to now unlock their cash by selling and saying, hey, you know what? I'm going to give up my 3% rate. I'll take a 5% rate because I'm tired of not having the cash to operate the business of my life. Balance sheets mean nothing. Credit scores mean nothing if there is no cash to pay that sustainable debt, in my opinion. That's the crisis that we're facing. As far as things typically go quickly or slowly, what was that, 12 to 24 months, what you said? Yeah, I think we've already been in that 12 to 24 months of the cash flow crisis. I'm not looking at listing account as the beginning of the problem. I'm looking at the cash flow crisis as the beginning of the problem, the step before listings go on the market. I also want to add this with demand. I think we have a fake demand. And here's what I mean by that. Do we need houses? 100%. But a demand also requires a ready, willing, and able buyer. Okay, that's the key that we have not had. We have not had ready, willing, and able buyers, or we would have had higher loan applications. We think of multi-year highs. We're talking 3 years. 3 years ago was 2023 when rates started going up, and remember 2022 was a heyday. Remember all the rates were super low. Everyone was locking in super low rates. End of 2022 they went up. Well, of course we're having highs. Rates aren't at 8% anymore. They're at low sixes. So, I mean, even dropped to 5.99. Of course that's going to increase people coming to the market, which is a ready, willing, and able buyer. So when people say that we have a shortage of 5 million homes, so we have the demand. Yeah, we have a shortage, but we don't have a ready, willing, and able buyer to do it. And that's what we've been missing for the economy is people that can have the credit or have the cash to make it happen. Does this make sense from my point of
So
view, Josh?
Colton, what you're saying is, and this was kind of one of my next questions was what puts it over, what puts it over the edge and actually causes the decline. So the way you see it, Colton, is that the lower that interest rates go, if they go that way, more people will list their home for sale, and it will be so many people at the same time that it will create an oversupply,
Yes,
and that will cause
correct.
prices to fall.
And this will be different because people have equity. We're not going to see foreclosures and short sales. We might see some defaults. We might see that go up. But this is more about a pressure release valve going on to where the valve will open up so heavy. We're already seeing a decline in condo prices. Condos are already down in many, many markets, over 20%. So why is it not reasonable that those continue down another 30% in the downward pressure of it? People can't afford to do anything right now. They don't have the cash. How many businesses, I don't know your background in business, Logan, so forgive me if you're like really brilliant in business because I don't know. How many businesses I've seen in my lifetime that are extremely profitable on paper, but they lack the one thing that matters, which is cash, and they go under. So I've seen heavy balance sheets of businesses fail simply because they did not have cash flow. Cash is the oxygen that America does not have for the majority of Americans. Even if you take the stock market's not doing great. The top 8 tech companies are doing great. The housing market's not doing great for most Americans. It's the ultra wealthy that are doing great in the housing market and buying multiple properties in luxury properties. The average American's not doing that. And the average American is what literally makes the entire economy move.
I have one question on the New World Order thing. We have 38 trillion in debt. Financial assets, U.S. has 200 trillion. If we actually take land and everything else, we're $400-500 trillion country. Why is the U.S. going to get hit, and Mexico and Canada and Japan and all these other countries that are smaller than us have weaker militaries, weaker growth in terms of their demographics, weaker wealth? How come those countries don't get hit first, but it's always America that gets hit? Because they have a $38 trillion of debt, but their debt to GDP is not even close to some of these other countries. But why is it that America is going to get hit first in the New World Order and these other countries are actually going to prosper because their currencies would actually do better when ours collapse?
I don't know that I understand the question with the other countries doing better.
Like
What
like
do you mean
like
specific?
you said, the New World Order, like America is going to collapse when it's debt, but
Gotcha.
if it collapses and its currency collapses, other currencies would actually do better then.
Yeah.
So,
Well, I disagree. I don't think other currencies are going to do better. Look at China. What really controls these currencies are central banks. And I think China and Russia are really good examples of just printing currency into existence. When I talk about the end and with this new world order, it's the new agreements of shipping routes. What has controlled every global economy in history has been shipping routes, and who's dominated those shipping routes post 1944 has been America. Prior to that, it was the British Empire. Prior to that, it was the Danish Empire, right? And so you can see these empires crash based upon who controls shipping routes. So my personal opinion on what you're seeing happening, especially with the move with Greenland, the move with Venezuela, and I think we've seen this moving for a couple of years, is we're seeing a removal of the European side for America, and we're seeing a Western Hemisphere type order. So you'll see a Western Hemisphere and you'll see an Eastern Hemisphere type order. Who will control the Eastern side will be China and Russia. Who will control the Western side will be the United States. You're seeing a shrinking of the global economy for the US. You're seeing a shrinking of the economy for China and Russia. You're seeing them separate.
I mean, U.S. is pretty much domestic consumption data. That's we don't rely on exports as much as the other countries. But it seems like the
Which is a
shipping
problem, which
it,
is
it,
a problem for America.
it seems like the shipping routes is probably something that will take a long time because other countries prosper by selling stuff. So as a world economy, everyone has a vested interest into keeping the selling of goods and services and products going. It doesn't seem like there's enough time for something like that to impact in 2026. That is
This
something
thing,
that
but these things have already been happening. You're seeing major signals of these crises right now. The major thing when you look at a business, Logan, Josh, is how much cash can I have to continue to sustain the expenses of my business? Because the moment I got to run out of cash, I have two options. I either go get a loan or I go raise capital. So we're Americans that are running the business of their life going to go get cash to continue the debt service because their balance sheets are fine. It's not that they don't have assets, they don't have cash. So where are they going to get the cash to make their payments?
So when you say they don't have cash, what data are you looking at exactly? Because the household debt servicing payments, just because 70% of all consumer debt is mortgages, like you said, a lot of people have very low mortgage rates, but their cash flow based on their household's cost is still very low on a historical basis. The worst it ever got was actually 2008 because of the recast of the loans, and the debt expansion was so much higher back then. The debt deleveraging took that ratio down. But where exactly is the stress for the homeowner? Like renters, I could understand. Like low income renters, I could get. But for households that have their debt payment levels, their debt servicing cost levels at really near lowest levels in history, are they really cash strapped
How do
to?
you look 100%? Look at how that data reads. That's based on averages. It's
Yeah,
based on
and that's
averages. You can skew the averages based on the ultra wealth. What shapes that data? What made America great? And I hate that phrase because I know it's very Trumpism. But what made America great was a strong middle class. We don't have a strong middle class. You have ultra wealthy, and you have everyone else. The everyone else, their averages balance out based on the ultra wealthy. The way that and I see this all the time when companies do extremely successful, the CEOs get detached from the reality of human beings and their psychological and emotional patterns. 95% of America is not experiencing what the ultra wealthy are experiencing. Josh, you're in mortgage, right? Is that what I understand is?
I am. Yep.
How many people are you talking to today that cash being strapped is a problem? Whether it's realtors, whether it's consumers looking to get loans, how many of them that cash strapped is their problem?
Uh, we have our fair share of conversations with people who are stressed about inflation and the cost of mortgage payments and the cost of groceries and gas, which is interesting because I hear your point of people are strapped, cash flow is an issue, and then when I listen to Logan talk about the macroeconomic piece, I've been frustrated because as a mortgage guy and as a functioning member of the US economy, I would love to see more transactions happen, getting back over that 4 million a year transactions. And I've spoken to quite a few people over the last several years where they would like to make a move. Maybe they have a 3-bedroom, 2-bath, and they want a 4-bedroom, 3-bath. And we run the numbers and they just can't make it make sense. Many of those people, and this is what's been interesting to me and at times frustrating, is um, if the rate was a little better, they probably make the move because the payment's more affordable, and they don't have to do anything, so they just choose not to. And I see the
Correct.
stress and the tightness, but one thing Logan's talked about that's kind of a counterpoint to that or a balance to it is qualified mortgage, which I lived through like you. I started doing loans in 1998. So I've seen several cycles already of this and that
Dude, by the
qualified
way, you
mortgage.
look like you're like 40 years old. How you been doing
I'm
loans since
45. I
19?
started when I was 18. That's part of my bio. My dad was a real estate broker, so I grew up around real estate, and he started a mortgage company when I was
So
18.
go back to those people and the pressure though.
Yeah.
What
So that's the
happens
interesting thing is like to your point.
psychologically and emotionally is the data that no one is measuring.
Yeah. Well, and that's where I, like as a person who talks to people and hears the emotion and sees the stress, and then I think about the numbers, like everyone who's bought a house since 2010 had to prove they could afford it at the time they bought the house. So even if they have, a high debt to income ratio on an FHA loan or something, like they proved that they could afford the house. So it's a different type of stress. It's stress, but is it stress to the point where they have to unload, like they're a forced seller? And will
No, they
we
don't
see
have to.
millions of those people do it at the same time to their own detriment? I, you know, I can't figure how people would do that. Just thinking about it myself, like, would I do that? Would I say, like, I'm going to just unload my house because
Well,
I want cash?
one thing about this conversation, there's actually more people with 6% mortgages than 3% and under. Like I know a lot of people talk about the mortgage rate lockdown. It's actually something I don't believe. Partly is because we have the coupon data and we get to see it every quarter. But every single quarter, people were selling their low mortgage rates and buying another house, to the point to where we have actually more people with 6% plus mortgages than 3% and under. And even the 3 to 4% mortgage crew, that went from like 41% of the data all the way down to 30. So people have been selling and buying homes transaction wise, and it makes sense. 2010 all the way down to 2022, rates ranged 2.25% to 5%. Pretty much the majority of the stock of people had sub 5% rates. There was only 5.99% of people that had rates 6% plus, and those were like very low balances with older Americans that had very old mortgages. But this has kind of already happened. People have been selling their low mortgage rate to get it, and the new listings data hasn't deviated. And this is why we always talk about trying to create a model based on anything, that if this was going to occur, then, for example, our weekly new listings data, I mean, we could do it for every city, state, zip code in America, but we do the national stuff because if something breaks where you have a surge of sellers who want to, they're tired of living in the new world order, that stuff happens, you'll see it there first. And then you have to get the transaction models to stick for the entire year. We have not seen any of that in any of the data lines going back decades outside of one period in time. Why? Because shelter, right? You have to obtain another form of shelter out there. And this is why housing moves so slowly, right? You can't just sell your house and be homeless, right? When you put your house on the market, if you are not a stressed seller, you're already looking to obtain another house. And that is why the inventory channels have looked the way they've had going back many, many decades. The difference what qualified mortgage did is because everyone was legit. Nobody can just list their house anymore and assume that they'll be able to get credit. So very simple model, 70 to 80% of all home sellers are buyers. There's 20 to 30% of inventory that's left. The one group that does not provide you a house when they buy is a first-time home buyer. So that's one of the reasons why inventory has been slowly moving lower, lower, lower. And even with the biggest crash in home sales ever in 2022, 3 years after that, inventory closed 1.18 million in December of 2025. It was 4 million in 2007. Normal is 2 to 2.5 million. So the velocity of inventory happening with people giving up their 3% mortgages to get something at 6, that's kind of been here for 3 years. And it really hasn't changed the inventory channel data or the supply and demand equilibrium ever. But if it was to occur in 2026, we'll be able to see it first because it's working from the lowest levels ever. The thing, new listings data will go vertical, inventory will go vertical, but our key is our price cut percentage data. The slope of our curve of people actually cutting prices. Like we could do this for every city, state, zip code, but nationally, that data line will have to surge up as well, right? And that's how we talk about housing economics with stuff that is happening today that everyone else will see it 2 to 3 months. And now that we're almost at the end of January, this better happen very, very fast over the next few months, because then after June and July, the seasonal inventories data starts to shift in terms of new listings, and then we'd have to wait for 2027. So you have about 2 months, 2 to 3 months for this to surge itself up. And so far, the last new listings data was 50,000. Back in the days where people were really listing their homes, it was running at 250 to 400,000. So you need
I don't
about,
think you have to see I don't think you have to see inventory go vertical. I think you have to see transaction count massively increase. And what would determine if that happens or not? It's very likely it doesn't happen this year. What determines that are those mortgage rates. They have to meet at a certain level where rates will say, hey, you know what? I don't love my 3 bedroom, 2 bath like Josh is talking about. I also don't love this auto loan. I also don't love the fact that I don't have a significant amount of cash to do anything else in my life besides sustain the life that I have. Because at some point, that stress and pressure, maybe not the pressure of what we saw in 2008, but the pressure of psychological and emotional, it adds up in the husband and wife. It adds up in the kids. It adds up into the single person. That pressure, psychologically, people make decisions. We talk about models. Models are cool, but like let's take the models of insurance policies. Like one of the most famous insurance policies today are indexed life insurance policies. Now they're tied to an index, and every insurance agent loves to sell this for one thing. They can show it's tied to the S&P, and they also get paid a bigger commission. That's my point of view on the commission side. They'll say I can stack cash. For those of you who know how those life insurance policies work, I can stack cash faster. But what they don't say in that model that they'll never show you is when I'm 80 years old, my premium to pay that policy goes up. The models have never worked in that policy. So whenever someone says, I'm going to model out the next 5 or 10 years, or even the next 12 months, the models aren't going to basically work on the shift of this order. You look at how history changes, it goes in saculums, about 20 to 25 year saculums. 1944, 25 years forward, 25 years forward. Around 2007, we saw us move into the last saculum, the winter season. We are almost 20 years into it. And there's between the last 5 years of a saculum is where a climax happens. A climax might be a massive global war. It might be a complete economic meltdown. It might be something that we don't even have on our radar. We are waiting for that climax, and that climax could be a major part of what shifts. What drives the market, Logan and Josh? Fear or greed? That's it. Those are the only two things that drive markets. It's not numbers on data. It's not statistics. It's not past history. It's where are people psychologically and emotionally based on where the world is. We're at a point, at a time in history we've not seen ever in our lifetime where there's more fear driving people's decisions. There's more protectionism. People are wanting to just simply protect themselves because they don't want to deal with the uncertainty that's in front of them. Have you ever seen historically a time that's been so uncertain as we see today?
So if all that
No,
is
hold
true,
on. Have you ever seen that? Have you ever seen that?
I mean,
Have we seen
World War
historically?
One and World War II were pretty crazy times.
That
I
wasn't
mean,
your lifetime. That wasn't my lifetime. That was historically, we can research it.
yeah, but
You
that
weren't
was
alive during then.
those were real like crazy times globally
I'm not
speaking.
saying that
But
they weren't. What I am comparing is today to that time. We are at that same stage in the saculum. What led up to 1944 when we had Germany invading everyone and that time happening was the climax of the end of the last world order. Who ran the previous world order before the US?
you tell me.
The UK, the British Empire. They were literally all over the world. Canada was under it. Australia was under it. Most of Africa was under it. How many of the Caribbean islands were under it? What happened at that climax when they decided to do something about it and push back against Germany? Their entire economy collapsed. Their entire grab across the world collapsed. Their protection of shipping routes collapsed. It is the same thing that we're watching America do right now with this idea of America First agenda. Let's protect the Western Hemisphere. By doing that, it is shrinking. We're not expanding the old world order. We're shrinking the old world order. And
So
it's
in
all in attempt to strengthen economically here. The only way economically it strengthens here is the American people's lives get better. And it's not getting better right now economically. It's getting
so
tighter.
with all that said, we could at least still agree if this is going to create a surge of people being stressed, we'd all have to see it in the new listings data, like the people that actually have to list their house, right?
Yes,
Because
but not vertically. Not
but I
vertically.
mean that's inventory vertically is different than new listings. New listings are people that actually put their homes into the
And we're
market.
going to see it in what prices of homes sell for.
But
You're
it
not
was
seeing prices go up. You're seeing, like I just pointed out earlier,
What Logan
condos
is saying
prices
is
are.
we have to see it. Like they would, Logan,
We have to
correct me
see
if
an
I'm wrong.
increase of inventory, but not vertical inventory.
but we have to see an
We're,
increase of new listings. Like
Listings,
but
it
that's
right?
not what
takes
you
We have to
said.
see
You
a
time.
said
lot
we
of.
have to see. You said we have to see it increase vertically. Those were your exact words. We don't
Yeah,
have to see it
you'd have
increase
to see it
vertically.
you'd
We
have
have
to
to
see
see
it
an increased number of transactions, which I believe are happening. And when that, we're already seeing a decrease in price. I was very clear. Condos. Look at the data. 20% down in most condo. How do I know? I've sold real estate in that market. I'm seeing it in that marketplace. You're already seeing it happen in housing.
So this is the baseline for the big 2026 crash then, that shipping lanes
Well,
and
I think you're
new world
this is a
order.
big part of it. I think you're just I think you're confusing in what a crash is and isn't. A crash doesn't have to look like 2008. It doesn't have to look like foreclosures everywhere, short sales everywhere. It doesn't even have to look like massive inventory increase. It has to look like prices coming down. The
Yeah, but
asset prices
you
coming
said
down
worse than
in real estate.
2008.
And this is
Yeah, I
so
think it will.
so so
We're already seeing price, we're already seeing home values in many markets, not all, down at least 20%. We don't have
Okay,
to
so
go, we're already getting that direction.
national home prices being down 20% is the baseline of the new world order, shipping lanes and people just fed up and they're going to sell their
I don't
house and
understand what
buy.
you mean. No, I'm saying all these patterns play into it. And it goes back to what I said with fear and greed. When you're stressed and when you're anxious, do you make great financial decisions? Yes or no?
Well, that's the new listings data, right? They're not making good financial decisions. They're rushing to put their house on the market so they could unload their stressful life, right?
and something I'll tell you
That's
something that I saw that Logan you mentioned that I thought was an interesting pattern observation was the at the end of 2025 we saw record numbers of people. Logan, I don't know if you know that the have those numbers, but record numbers of people withdrew their listing as opposed to dropping the price a bunch to make a sale, which I thought was interesting and kind of supports the theory of like there's a lot of equity. People would like to sell at a price of X, but if they can't get X, maybe they'll just wait
the
around.
deal.
If they can't get X plus at the right purchase on the new house, but if all of a sudden maybe they can't get X and they're getting Y, but they're getting Y, but also Z, which is the new interest rate and the new purchase makes sense, then they'll do it. So Y is down here, X is up here. They couldn't get X, but also Z was clear up here still. So if Z comes down, we can see prices come to Y.
That doesn't imply a crash though. That's like a supply and demand equilibrium of buyers and sellers working off each other. I mean,
What is a crash? Define your definition of a
well,
crash.
for example, worse than 2008. 2008 was 29% nominal, right? So if it's worse than 2008, it would have to be worse than that.
Oh, I understand that. And what is the definition of a crash?
That it's worse than 29% nominal home prices.
No, that's worse than the
I
2008 crash. I'm saying what's the definition of a crash, not the 2008 crash.
well, you
Is
said
it is when we start to go below 20%. And I think that number, which we're already seeing in many areas, will go beyond the 29%. I think we can see as much as 50%. I
okay.
think you can
So
see a
is that a
$1.8 million
2026
property.
call? Because if that's a
I think that
2020, if that's a 2020, you don't have a lot of time for that to happen because you would need to see like either really, really big volumes of transactions to bring the median sales price, which actually has never happened in 100 years.
well,
But you also,
let's look back and go back to the video that first started this. You're stuck on the hook, but what did the rest of that video say?
the rest of the video didn't make sense to me, but the hook was the interesting aspect
That's
because
everything I'm saying doesn't make sense to you, Logan, because you look at all these historical data that doesn't predict the future in a new
I know,
world
but
order.
you're talking about shipping lanes and new world orders and
Right,
America stress.
because that changes the entire dynamic geopolitically, domestically, all of these, like what you're seeing in Minnesota, what you're seeing political divide right
Well,
now.
I think
A really good book I would recommend is Changing World Order. But what I'm essentially saying is, what did the rest of that video say? That video was very clear that
It was
indicated it was
basically
dependent upon where mortgage rates go.
people you're talking about a rising sale environment and a crash in prices which has never happened in history. So you might not like models, but that's never occurred. We don't
You know
need.
what else hasn't happened in history is we invaded Venezuela. What else hasn't happened in history is what we saw this whole happen in the World Economic Forum right now. You're seeing happen today and you will for the next 5 years. It's never happened in history before.
But
That's what
this is
makes it history.
2026. That kind of velocity movement in housing
Understood
takes
completely.
a
And what was the
very.
whole basis of that video? You're arguing a hook of a 60-second short instead of the context of the video, which was very clear about the 1.25 trillion in debt and all the pressure coming on Americans dependent on will Z come down? Interest rates. If interest rates stay at 6%, you're not going to see a crash. If interest rates come down to 5.5, 5.25, which is possible, you will start to see that happen.
That's never occurred in history. We've never had rising sales and big volume
I understand
transactions
what's never
in home.
occurred in history. What's also never occurred in history is the collapse of an American empire.
Yeah, but do you think that's a little bit extreme for
I don't think it's
2026?
extreme. I don't think it's extreme. I think we are in a complete collapse of every order that America has known for the last 85 to 100 years.
And who
That's why
replaces
we
that
have so
order?
much divide.
Who
That's still
replaces
be
that?
determined. That's still be my perception. It will be China, Russia, and America. It'll be a
So
Western
this is a
hemispherical
BRICS
order.
thing. So America versus the BRICS.
I don't think BRICS, because I don't think South Africa, I don't think Brazil is going to be a part of it. Brazil is Western Hemisphere. South Africa won't have much say in it. You're going to see those BRICS kicked by the sidelines. You're going to see who controls the Eastern world and who controls the Western world. That's why Greenland is so important, because of the Arctic shipping route.
And you think there's enough time in 2026 for this New World Order thing to happen in a meaningful way?
It's been happening in the meaningful ways based on the rates. I said it 6 times now. It's like your ears were painted on, dude. What
But
did my video say? It is dependent upon the coming down on the interest rates.
Rates came down from 8 to 6% already, like 6 to 5.5%. It's not going to change the supply and demand.
What did Josh just say about that person in 3-2? You know what? If I can't get X, I'm not willing to take Y, because Z is still too high. That is the whole basis of this. We haven't seen the rates meet where the pressure of people are psychologically, emotionally.
I've never seen data where you have rising sales and prices crash. That's just not. It's just I don't even have any data about
Completely
that.
agree. I completely get it. I get it. You haven't seen it. You also haven't seen a world of $38 trillion in debt.
Well, we're a $500 trillion company, or not company, but country. I mean, the United States has an unfair advantage over China, Canada,
Yeah,
Mexico.
they do. It's the reserve currency.
Yeah. So why would their currencies do better than ours?
I'm not saying their currency will.
We have the biggest military. We have the biggest economy. We have the biggest, most wealthiest middle class. We have over 200
You'll see a
trillion.
separation of those economies. They won't operate off the American order.
There's not enough time for something like that to happen in 2026.
I'm not saying that there is enough time for that to happen. I'm saying that's what is happening. I'm saying what would cause this, what we're talking about, is rates coming down.
Rates coming down from 6 to 5.5% is not going to create a crash, a nominal home price crash in 2026. That doesn't
That's where we agree to disagree.
Could it be 2027 or 28? It's an interesting thing. So let me ask you guys each a question. Colton, I'm going to go to you first on this, and then Logan, same question. Is Colton, if it turns out we're sitting here on this podcast on December 31st, 2026, and you were wrong about this prediction, what would have happened or not happened for that to be the case and home prices don't crash, say they stabilize? What would happen to make that?
I think the rates stay exactly where they're at. I think
so
that's what happens.
If rates stay even or kind of flat, then we kind of can continue and stabilize in your view, how you see the world working.
Yeah, I think rates stay flat if that's the case. And I think the other thing is a black swan, which is something that I can't predict, that is not on my radar.
And Logan, if you're wrong and we see a massive crash of more than 29% in home values, what would you see on the data? What would happen for that hypothesis?
So I actually modeled this out to what we would need to see to get a 20 to 29% crash. Rates actually have to go up in a very fast amount of fashion, because the slope of our curve of our pricing data got very negative and home sales start to crash. And whatever supply is on the marketplace, those people are necessarily have to sell in the calendar year. So higher rates and weakness in demand, that could facilitate the products that are available. Those people have to crash. And it happens in such a fast amount of time that people just sell just to be able to move in the calendar year. Something like that could model itself out, but you need home sales to crash in the calendar year for this to happen. It can't be home sales rising, right? Higher rates can do that. And we showed that in 2022. The slope of our price curve with the biggest, fastest crash in sales was actually igniting. It just, everything stopped around the 4 million sales mark. So higher rates, weakness in demand, supply goes up, new listings to go up, and people unanimously all together sell their houses at a discount rate to get the product up. That to me, if you modeled something like that out, that could make sense. It's never happened in history, but at least you could connect the dots somewhat with there.
And I see, and I get, Logan, you're using models and historical precedents, which I totally respect. Colton, you're kind of like future casting off of patterns you're seeing and things that might happen and coming up with. So something interesting to me as a
Future
mortgage guy.
casting and future casting off of a new world order, something that we've never lived through before.
Right. So, that's fascinating. It was interesting to me that what your hypothesis was like if we see lower rates, because I was, as a mortgage guy, looking at credit, tax returns, talking to clients about budgets. My mind first would go to higher rates causing that problem because it would stop people from being able to make a move. Like we've helped quite a few people that were in a situation where they bought a smaller home for a lower price, got the equity out by selling their bigger house with a lower rate to pay off, to your point, of credit card debt, car loans that were upside down, things like that, kind of reposition. So if interest rates went higher, it would make that math more difficult, and then maybe that person, if they get stuck long
I
enough,
agree with that, and we won't see rates go up though. I mean, that high substantially. Why? It's
because
called
8
quantitative
was like
easing.
crazy. We were at 8 1/8 for a little while.
It's because they cut off all
In
the printing.
2022.
They did reverse quantitative easing. Like I like, let's take the Trump administration. All these presidencies do is they're great marketers, and Trump's just a better marketer right now. Now, whether people agree with his marketing is irrelevant. But you know what he did in COVID? No different than the Biden administration. Printed money. They have been printing so much money is because that's what keeps the empire afloat. The illusion of control.
So
That's all Trump's doing right now is
you
he's
don't
posturing
think
like a freaking peacock.
you don't think the U.S. can ever sustain its bond issuance? Is that
Yeah, I don't think it's possible.
so? Like it goes back to your
Unless they
original question.
well
Like,
think
why is the U.S. in that category and not other countries? Like, why are they
no,
able
they're
to
all
borrow?
they're all in that category. And so when it collapses, what goes to protection mode? What is the big talk in
Okay, so
Davos right now?
you're talking about a global, like a global problem. Like this is not just the U.S.
Yeah, this isn't
Everyone
just
is
a
going.
U.S. problem. This is
Everyone's
going to be a
okay.
global problem
So this
for sure.
is a global bond issue, and nobody will be able to print anything anymore.
No, I think this is the beginning of, I personally believe that the new movement will be decentralized. And so if you look at the big topics of conversations at Davos, I don't know if you guys have been following, what is almost every European country saying that they realize now because of the threats of Trump's administration? Shit, we might need to figure out how to protect ourselves military wise a little bit more. We might need to figure out how do we replace the economic balance between US and Europe. You're starting to see more countries have conversations with China. You're starting to see them. Well, what is it that we do to have to sustain? So I don't think it's just an American problem. I think it's a global problem for
Okay,
sure.
so the new world order is a global problem. It's not just the U.S.
Well, yes,
Everyone's going to be
absolutely.
part.
Just the
Okay,
old world
all right.
order, it was controlled by America. We're not so much.
Okay,
It's not. That's not going to continue forward.
okay, that makes a little bit more sense than the U.S. being the only country that
Yeah, I
would
don't
have a
think
problem.
US is the only problem. I'm
Okay,
sorry if I communicate that wrong. I think everyone's in a problem. And when everyone's in a problem, it goes to even more protection mode. It goes to even more fear driven decisions. If rates went up, hypothetically, yes, we would probably see a crash. I don't think you'll see let the central banking and the Federal Reserve allow that to happen. With that announcement of Trump saying that they're buying $200 billion in mortgage back or something recently, was the number 200 billion. Is that right?
yeah, that's kind of a small number. That's a $7 to
But
$9
what I'm
trillion
saying is, how long have they been doing that?
They haven't bought mortgage-backed securities for a while.
But how long historically? Let's look over the data.
I mean, They never bought until 2010. And then
And how
after
much have they bought
2014,
since 2010?
they stopped buying in 2014. And
And
then
how much did they buy during that time?
they bought about $2 trillion worth.
$2 trillion.
Yeah.
And now we're starting to buy back again. Why does any company do a buyback?
Well, that's Fannie and Freddie. That's not the government. That's
No, but why does anyone do buybacks?
they're just making the spreads a little bit lower.
And where does the money come from to make these spreads lower?
Freddie and Fannie has it on their balance sheets.
And where did they get it on their balance sheets?
Their money that they made off loans.
And where did the money come that made off the loans?
Mortgages. People pay their
And where did
mortgages.
the mortgages come off the loans?
Jobs, incomes.
No. What happened in the crash in 2008?
Listen,
Remember the first 900 billion bailout? Where did the monies come from?
This is going like you're talking
No,
you're talking about a boogeyman theory for this year.
This is boogeyman, bro.
This is not
The amount of money that
this
they
is
keep
Dr.
printing.
Jekyll. This is Ray Dalio. All these people are talking about the end of the U.S. empire because of what happened in Britain. I mean, this is it's already January.
This is historical data.
We're not
drives
Germany.
The Americans?
We're not the
what
UK.
Drives human beings are psychological and emotional fears and greeds.
We are the wealthiest country in the history of the world.
I'm not saying we're not.
There's none of this stuff.
I'm not saying we're not. That doesn't
change
the emotional state of the average American.
There is no emotional state for this to move off of. You're talking about big titanic global events that are going to shift
that have been happening since 2007. From 2000 to 2008, we went from 0 to 8 trillion. From 2008 to 2010, we went to 21 trillion.
Majority of that is mandatory payouts that go out to older people.
2020 to 2026, we've gone from 21 trillion to 38 trillion. You don't see that trend?
No, the debt to GDP here is lower than other countries. Well, like Japan has to blow up first for the U.S. to have anything.
So what you're saying is you've seen it escalate out of control, the debt.
Out of control, even on the GDP side.
So why are rates so low?
Debt to GDP is still healthy. Like if America was a mortgage borrower, they would have a very low debt to income ratio. That's Logan's point.
If America's in trouble, they'd be borrowing at 20
That's based on because they've printed all of this currency that they can now use to spend. What drives economy is cash and credit. They get to be the creditor and they get to be the person with the cash.
Then
I don't get to be that. You don't get to be that.
That country doesn't break like that in 2026. That like third world countries,
I think
off the dollar. That's
you guys are saying something deeper. So Logan, you're saying in 2026, and I think what you're saying is, correct me if I'm wrong, Logan, is this doesn't happen. Your worldview. This
doesn't happen in America. Other countries have. Other countries
not 2026 or 2030.
Yeah.
And if it is a global problem,
debt systems first.
Right. That's what I was just kind of pointing out for the viewers watching this. Is what you're saying is that let's say this global thing blows up and we have a new world order. The U.S. has like the most bombs, the most.
We're the last person standing always. I mean, Russia, China.
If it's a Chapter 13 bankruptcy, we come out on top, right? That's basically
100%. I agree with that, but that doesn't change what we're talking about on the topic of this. Is where are American people psychologically and emotionally because they don't have a never-ending bank account.
So this is something that I think maybe you guys could agree on. I'm going to go crazy on this right here. So if there's a new world order and we have a world collapse, okay, and America's the last
when. It is a guarantee. There's no if about it. It is happening.
So on your worldview, that's a certainty. It's just when. If that happens, right, we still globally come out on top, but in that scenario, home prices fall. That's where you're coming from, right?
And Logan, it is a reset.
And Logan is saying, my worldview is that never happens, and so therefore home prices don't fall like that. Does that summarize both of your
yes, for 2026? Yeah, that's just not this.
And Logan, what I'm hearing you say but not say is, if you see different data show up or patterns start to show up, new listings, different things like that, you're not married to the idea that home prices could never fall more than 29%. You're just saying,
You would
I want
need,
to
yeah,
see
home
the
sales
trajectory
crash,
change.
inventory goes up, price cuts percentages. Those things have worked with housing cycles for decades and decades and decades, and we'll see it in the data. So it's too late in the year to have like that big of a titanic shift in 1 year. That's something that has to be progressed out for some time. But housing just doesn't move that fast. Stocks can move up and down like crazy, right? It's a very liquid market, but housing, just the ability to list a home and sell it, and there's just not enough calendar days for something like that to happen in 1 calendar year. It has to be progressed out for some time.
So I think we can all agree here that we love housing.
I think don't wait to buy real estate. Buy
we have some
real estate
agreement
and
on
wait.
that, right? Yeah.
Yeah, I do think single family housing is not the best investment over the next decade, but that's a whole other podcast.
That is. I'll love to have you on to talk about that. Because this has been fascinating. I think, people watching this will agree or disagree strongly with each of you, depending on how they see the world and what they believe. So I appreciate you guys both being willing to come on. I appreciate you being respectful of each other because I know these are passionate topics, and I appreciate the conversation. It's been amazing having you both on. Do either one of you have a final thought that you want to share before we wrap?
Just follow the weekly tracker data, and it'll guide you 2 to 3 months out for the rest of the year, like it has for the past 2 decades.
Thanks for saying that. So, and Logan, I don't know if you want to, plug where they can get that data.
Housingwire.com. We have a top 10 business news podcast with Sarah Wheeler and I, Housing Wire Daily. We talk about that stuff. If we see shifts in any of the housing or economic data, then you could hear it there at least. And then we could take it from a historical perspective on where we connect the dots with.
So people can follow you on Instagram. I'll put that in the show notes. They can go on Housing Wire, get that data. You write a weekly tracker. It's beautiful. So appreciate that. Colton, where can people find you and catch up with your
best place is Instagram, WGR. So you just put that in the notes, and I think it'd be great to look at that data. I think it's great data to always see and just understand that historical data is based on the old world order, and you cannot rely on old world data in a new world order. And I think a lot of people are in denial that the fact that the old world order is collapsing in front of us, and there's so many different signs. And so you're wondering, what does all of this trade routes and shipping routes and Western Hemisphere have to do with it? It's just giant signals that data is not going to be useful going forward much longer, because the old world order is coming to an end. I don't think Logan liked me.
Thanks for joining today. Appreciate you.
Thanks. We'll see you.
Later.
Bye.
You were made to be great. Don't settle for less.